Good evening, ladies and gentlemen, and welcome back to SF Live. I'm your host, Myrna Lim. Tonight we have a special guest, Brian.browne. If you would recall, Brian has been giving us presentations regarding our economy, regarding the stimulus bill, regarding the financial bailouts that cost the taxpayers trillions of dollars. The stimulus bill had been passed by Congress and signed by the President about a month ago. And now we're looking at what the stimulus bill is doing, if in fact it's helping the public. Good evening, Brian. So what do you think of this stimulus bill?
Well, I just wanted to say the first stimulus package that was signed was the TARP, Troubled Asset Relief Program, which was to help the financial intermediaries in Maine, but it also could be used in other directions. This stimulus package signed by President Obama is mainly to, like a FDR type Keynesian approach to stimulate directly employment and consumption and get us through the tough times. So on one side, we were looking at stabilizing the financial crisis in the financial markets, and this one is to get people back to work. And of course, the two events are highly related. I mean, one caused the other, and they imploded back upon each other. I think it's a good idea. I don't have a lot of knowledge exactly how every dollar will be spent, but I think the important thing is to get it in the hands of those people who don't have any money now, so that they may support themselves and then support their grocer, and their grocer supports his wholesaler, and that whole chain, which in economics they call the multiplier, the employment multiplier effect. And that's what the president is trying to do.
Do you think that the money now is going to people's hands, though?
Myrna, that's a tough question to ask, and it's a good question. It's an excellent question. I mean, if somebody is ill and they want to get medication to them, they try and put it into a vein directly. The other way is they can give them a pill or something that takes longer. So I think what you're asking is this money getting in the consumer hands?
Exactly.
Exactly. And I don't know. I looked at some of the San Francisco projects in detail, and some of them look like the money, at least in the area of the San Francisco Public Utilities Commission, are going to more planning and not sending people marching with bulldozers and shovels out to the Irvington Tunnel and giving them jobs.
Right.
Although it's touted, the total package for the they call it WISIP, or Capital Improvement Program, of $4.4 billion, and some of that will now be offset apparently by stimulus package money, has not yet reached the level where a lot of people are being hired in terms of doing actual physical work on the major infrastructure. So you have to look at all those type projects around the country. Are they putting people back to work? I think the relief for the state, and that was excellent, and it's definitely a move in the right direction.
Right.
But is it the best move, I think is what you're asking.
Well, I guess the question is, the whole idea, Bill, would be that the intent is to put America back to work.
Right.
And that would be done through all this infrastructure development, and such infrastructure development are supposed to be shovel ready, right? But if you look at the projects, some of them are at least like a year away, or a year and a half away, or some are even a couple of years away. How is that supposed to create employment? Basically, when we're talking about creating employment, it's the now. People need a job right now. They have to pay their bills, they have to put food on the table, they have to get their bill collectors off their back, and they have to pay the mortgage. So if that's not happening, then there's something wrong. What do you think about that?
Well, we spoke earlier about the Townsend Plan in the Great Depression, and he was a physician that suggested that every retiree in the country over 60 get $200 a month.
Right.
And that was an immense amount of money in the early to mid 30s.
Right.
And you're asking, are we doing something like the Townsend Plan, getting people to work, like the Jobs Works program that FDR initiated, where people went out, built dams, great infrastructure projects? I don't know. But I think people do need to work. It's very depressing to watch, like tonight on the news just before I came here, food trucks going around towns in the Midwest delivering food to these small towns and cities where people just need to eat.
Exactly. Well, even in San Francisco, a friend of mine, of course I didn't see this, but close to the Civic Center area, where there's food lines, and a friend of mine was telling me that she almost cried because before she would see, homeless looking type people, but what she saw was quite a change. There was a whole line of people, young yuppie type people with their suits on and in line for food. That's unheard of in a city like San Francisco.
Yeah, I was hoping in a way that there would be a combination of a Townsend type plan for people that are unemployed and don't have any unemployment coverage.
Exactly.
And of course there's some disincentive when you do that, because people might stop working or looking for work. But right now we need probably to look beyond that and think about getting people back to work and so forth. And possibly we may have overspent with these financial intermediaries. I mean, a lot of people think and believe they should have let the market take care of them, let them go belly up, and use those funds from the Troubled Asset Relief Program, TARP, and use it to put people back to work directly, or to give people that didn't have money, like a Townsend type plan.
Right.
I mean, this is quite Keynesian. I don't think that this is the root of the problem. I think the root of the problem comes from the money supply and how it imploded and why it imploded. And we spoke about that the last time. But we now have a crisis. We have a crisis of hunger, of desperation, a lot of people out of work. And I think that the projects that I'm familiar with that San Francisco is seeking money for, I think will take maybe years to actually get people working on them.
Exactly.
And that concerns me. And that's what we'd like to see. We'd like to see that direct injection into the employment vein. And we need that now, because we need people to get back to work, to feed themselves, their families, and all the people that depend on them.
Well, I think the model that was created by Congress on the stimulus bill, it's like relying on the trickle-down theory, that they have layers upon layers of institutions that they have to fix, like the finance industry. They're trying to fix the finance industry and unlock the jam that on these credit market, and at the same time they're trying to fix the housing market with all the foreclosures, and at the same time trying to assist the different states like California to keep the state going with the firemen, the law enforcement, the teachers, and so on and so forth. So that's a lot. I think there's that long term that you need to fix. But the short term being is that people need the money now. People have to work now. And if you cannot create that job today, then you have to figure out a way to get the monies to people because they will spend it. Now, what comes to mind is a long time ago, you had the Peace Corps programs. You have like the employment development departments having training programs. You have VISTA programs. They put monies and training right within the reach of people. They don't give a lot of monies, but enough to pay the bills, enough to pay the food, enough maybe to get a little bit of money to pay the rent, and perhaps a certain percentage of the mortgage, and help them keep on going to help them look for a job. What do you think about that?
Well, I think that's very important, and I think tonight I heard the president at the Hispanic Annual Conference, and he was speaking about investing in education and making capital easier to acquire and tuition for students to go back to school, and for students of all ages, from young to old, and to invest and retrain. And I thought that was a good move. You know, they don't have a recipe for this. They didn't have like they drill for war. They apparently didn't drill for a major crisis like this. I think that one of the things they must do quickly is restructure the financial system. And I'm not an advocate of government involvement, but the government is tremendously involved right now. It owns 80% of Citicorp and things like that. It's got equity positions, and but they have to restructure it in a way that allow markets to work, also allow oversight to work. And they can't change it continually. That was all those changes that we spoke about in the prior discussion on this. They need to have a non-discretionary model for regulating the financial industry, and they need to have strong oversight. The type of things that that happened with the SEC knowing and being told that the guy had a Ponzi scheme going. And I think that they also need to be focusing on just what type of institutions can create money via the credit multiplier. Like, basically, that's what happened in 1999 when they passed the, what was it, the Bill, I forget the exact name of the act. They merged the functions of banking with the...
And get them out of their books and try to make them healthy again so that they can be healthy and start loaning people money. But at the same time, you have somebody who's starving to death. You have unemployment that just skyrocket. You cannot wait, you know, for the financial market to fix itself.
No, I agree with you. I think that the first thing should have been a Townsend plan for these people that are in desperate straits, or something like that.
Exactly.
And the other thing is, I'm not suggesting for 1 minute overly regulating the industry. I'm saying set regulations that allow markets to work. Don't change them all the time like we've been doing, and change them in favor of whatever lobby group can get them changed so that they can get an edge. And they've got to be, and then also the problem of the money supply. We must sit down and talk about whether the current arrangement of having the Federal Reserve Bank, it's a privately owned bank, issue our money supply, whether we should talk about the Treasury doing that function. Many economists and people in Congress, like Ron Paul, are suggesting that. And a lot of the economists to the right are suggesting we should have just let them go belly up. That the market, there was a sickness, and that the market would have self-cured. So, but on the other side, you and I talked about the Townsend Plan, or something like you've got to feed people, you've got to make sure. I mean, that's our social justice approach, that Americans shouldn't be starving in their own country. And that does make a lot of sense. And I have a lot of concerns about the TARP and why they
Well,
did it.
my concern is a number of folds. First of all, I'm really bothered by AIG. Okay, AIG has already got what $120 billion with the TARP money. Then they come back to Congress and say, well, we need $30 more billion. So then they're saying if you don't give us that money, then you will have a whole global catastrophe. All of these financial institutions will collapse because, because we've insured all these people and so forth. First of all, that argument in itself has a lot of holes in it because, first of all, AIG was supposed to be an insurance company. But then they got into derivatives. So the question is, if our government keeps on giving them money, is there like a hole somewhere where all of these monies are being drained anyways? Now,
I mean, I've heard that the argument that they must be bailed out because they're too large to fail. And if they fail, they not only bring the United States economy down, they bring down the economies of many, many other countries. But I will... Let's say that's true, and that we have to help them out at this point, but don't we have to seek vigorously accountability why this happened and make sure it never happens again? And I don't know the answer, Myrna, if we just said jump in the lake and they did go down, or whether they would bring the rest of the world down. As I said, the very conservative economists, the libertarian types would say, let it go. Let the market correct it. But we've chosen a different path. And I hope that in choosing this path and taking money out of your pocket, my pocket, and everyone else that pays taxes, that we find out what happened and hold those people accountable.
right.
But we are gaining an equity share in AIX too, the government, if it bounces back. We need to just go back to basics,
Right.
I believe. We have to look at our banking system. We
Right.
have to look at our money supply system. And we have to have reasonably unchanging rules and regulations. You said, like, we've had the Glass-Steagall Act in
Right.
place. The Banking Act, I think, was 1933, and it started to be dismantled in 1980, and then more in 1999, and finally in 2000 it was completely dismantled. We don't want to make those sudden changes that we did that allowed all these people, these very opportunistic investors with their gadgets, their financial gadgets, their very complex gadgets that people couldn't see through, with tremendous information costs to understand what these people were selling you. They made like you were buying a house, but you were buying the direction of what the sale of the house, whether the price went up or down. Same with wheat, all those type of things. The derivatives, we talked about them. We talked about the phony insurance policies and credit default swaps. That's all they were. They win because they weren't backed by anything. Now, one of the problems, insurance is different to banking. If a bank goes belly up, they got the FDIC, and now it's up to $250,000. But if an insurance company goes belly up, there might be some small fund in that jurisdiction, that state, but there's no agency for reinsurance, the equivalent like the FDIC, that will reimburse these people. So you've got to think of, if you pass away, I pass away, you've been paying your insurance off hundreds of dollars a month, bingo, that's gone. So they're balancing a lot of balls in the air and trying to figure out what to do. So that's one argument against the free market solution. Just let it go back, reconstitute itself. You might find that the free market solution might be that people might buy those insurance policies back and guarantee them, like they're buying up the failing banks. I don't know the exact answer. I think, but we've got to go back to the basics and get control of the money supply, and then make sure these other financial intermediaries don't have such a volatile swing on it and can create so much by fractional reserve banking. Fractional reserve banking is a giant Ponzi scheme.
Right, of course.
Yeah, I mean, you deposit $1,000 with me and I'm a bank, then I give you an IOU and then I loan out 900 and that process keeps going on until it's exhausted depending upon the reserve requirements.
Right.
Well, you get other people doing that and the money supply becomes somewhat unstable and also very volatile, because when you get these other people can't hold their position as their reserve requirement, the situation implodes, and then it implodes on the rest of the financial markets, and you see the disaster we've had today. And so we've got a lot of things going on, and it's unfortunately above my aging abilities to keep it all in place. Well, I'm not a protectionist. I mean, I believe that markets do work, but I believe a lot of, like NAFTA, and that happened too quickly, too suddenly, and were poorly planned, and we didn't think through how we would retrain our people, re-educate our people, and how we would cushion the shock. It should have been phased in. But I can't become a protectionist at this age in my life. But I understand. But if we're giving tax breaks to these companies to invest overseas, if we're subsidizing in any way, we're shifting that comparative advantage. We're subsidizing it and tilting the table in favor of doing that. I'm against that also. But I think that you have to step back and say, well, look, are these people like Ron Paul and Dennis Kucinich who are making these statements? We've got to reorganize central banking. We've got to maybe have a species. We have to have gold or something like that backing up our currency. They're making broad statements. Should we get rid of entities like the SEC? I mean, there's a lot of things on the table, but the first thing that we've got to do is feed the people, which is right.
Exactly.
But we've got to go through these things. And one of the things that concerns me is I see the same players that were there when the problem started, got bad, and they're now redesigning this. They're designing the solution. And the same cast of characters, they keep rotating it through my television screen year in and
Again, this is Myrna Lim, and thank you so much for joining us. Good night.
finance companies, the investment bankers, and whether the Fed had some control over the banking industry, where it would keep maybe a ratio of whatever, 9 to 1, whatever it is, in terms of cash to outstanding debt. But these people went 30 to 1 and things like that, and they basically were unregulated. It was a shadow money supply that was built on very fragile foundations, which collapsed so quickly and imploded. In fact, I've read that it was equal to what the Fed estimates the total of, this M1, the most liquid, various M2, M3, M4. It was equal to M4, which is a lot of money out there. But it was very unstable, and so...
Well, I remember the time when deregulation, banks were doing banking, investment banking were doing investment banking. Those were two separate things. And even in real estate, real estate brokers, real estate entities were separate from investment banking. Now, if you look at a lot of these huge buildings, a lot of them are owned now by financial institutions, quote. But what was striking, though, was when I talked to the guy from the Small Business Administration, and I says, well, there's no financing right now. And a lot of small businesses are losing money. Hey, if you can have B of A, if you can have Rite Aid, major corporations going bankrupt, what about the little guys, the little people? I says, how do we get financing to reorganize our small businesses and so forth? And basically, what he said? He says, well, banks would obviously have to look at affordability of payment. Well, hello, I mean, small businesses are hurting just like everybody else. If you cannot apply the same parameter, the same standard, the standard for financing would be if you have an 800 score. How many people have an 800 score for financing? Well, how do you put that back together? Small businesses create 90% of the jobs. So that, in a sense, that's a problem right there. And businesses are not qualified to get unemployment, and could never, ever get that. So what gives? What do you think about that?
That's a fairly complex question. One thing we didn't speak about in the last meeting was the 2005 Bankruptcy Act. The 2005 Bankruptcy Act, which Clinton refused to sign, which the Republicans and a number of Democrats had put before him, he refused to sign it. Bush did. And it's quite draconian. There are many things that are not accepted. There are many exemptions that you can't go into bankruptcy over, and so. At the same time, they passed this very tough bankruptcy law, and a bankruptcy law was originally conceived to let people absolve themselves from debt and move forward. I'm not suggesting people go bankrupt, but I'm saying they made it much tougher. And then at the same time, they were making these permissive loans to people, the same people that would come back and ding these people on their credit. It was sort of an implosive type situation.
Right.
Now, how do we get the financial markets? Well, I think they're trying to do that.
Right.
But it seems the Federal Reserve Bank focuses too much on the interest rate. It can lower the short-term interest rate, and it can do things it can lower the short-term monetary interest rate, and it can lower the long-term monetary in a sense, but it won't be over the long haul, because the interest rate is not. We quote the interest rate in a monetary sense, but the interest rate is really based on two things. It's based on the ability of a society to produce future goods, and it's also based on the preference of society to choose between future and present goods, just like supply and demand. And that's the real interest rate. And that's one of the things that we should be focusing on, is making the economy efficient. And I think, and then we should be working on the money. What I'm trying to get to say is that we should stabilize the money supply, get it under control, and not be focusing on the interest rate all the time. And I like the idea, and whatever represents the money supply right now, because it's somewhat complex, but as Milton Friedman said, the economy can have a natural growth of approximately 3%. We should grow the money supply at that. That should be the function of the Fed. In fact, he suggested that you could replace the Fed with a personal computer that ensured that the money supply only grew at approximately the same rate as output, which would mean zero inflation or very low inflation. So how they do that, I don't know at this point, but I'm a little confused. I have been confused with Federal Reserve policy. It seems to be focusing not on the money supply, but on playing games with the interest rates.
Well, see, here's the dilemma that I see. For the banking industry, we're saying, okay, we have to create regulations so that in the long term, these type of problems will not happen again. And at the same time, we have to deal with the toxic assets that the bank